If you're single and planning to retire with $1 million saved, the retirement math changes more than most people realize, because most retirement advice is built for couples. 2 Social Security checks, shared expenses, shared tax brackets. When you retire solo, none of that exists. And if your plan does not account for that, you could end up paying more in taxes, taking on more risk, and running through your portfolio faster than expected. Your situation is different. Not worse, not better, but different. Today we're going to break down what's different for single high net worth retirees, income sustainability without spousal layering, withdrawal sequencing differences, survivor risk planning, and long-term care risk concentration. Before we dive into all that, my name is Ryan Knoll and I'm a certified financial planner and founder of Nav Wealth Partners, a financial planning firm helping clients nationwide make smart money decisions. Let's jump into the video. Let's talk about income sustainability without spousal layering. When a married couple retires, they often have multiple income layers, 2 Social Security benefits, possibly a pension, IRA withdrawals, and taxable account distributions. There's flexibility. If one income source is lower, the other may compensate. As a single retiree, you have 1 Social Security check, 1 lifetime income stream. That makes guaranteed income far more important. If you're single with $1 million or more, your portfolio may generate strong returns, but market returns are not guaranteed income. Something like Social Security, though, is. For single retirees, delaying Social Security until age 70 is often more powerful than for couples. Well, why is that? Because it increases your personal inflation-adjusted lifetime income, and there's no spousal benefit to fall back on. Your Social Security decision becomes your primary longevity hedge. And when you don't have a spouse's income to share risk with, longevity planning matters more. But it's not always so simple. You also want to think about the cash flow you will need before taking Social Security. I often find that having an idea of what income will look like before collecting, regardless of when that might be, is the most important factor. You don't want to delay Social Security if you cannot reasonably sustain a higher withdrawal rate from your portfolio for a short period of time. You may need to map out cash flows and stress test it, specifically stress test it with the after-tax outcomes. Understanding where that income comes from, using the least amount of capital as possible after accounting for taxes, is the key to success, which leads us to withdrawal sequencing. And withdrawal sequencing looks different when you're filing as a single taxpayer. Single tax brackets are compressed. You reach higher marginal rates sooner. IRMA Medicare thresholds are lower. Capital gains brackets phase in faster. This means sequencing withdrawals across traditional IRAs, Roth accounts, and taxable brokerage assets requires tighter coordination. For example, a married couple may comfortably withdraw $150,000 annually while staying in moderate tax brackets. A single filer might hit higher marginal rates at lower income levels. That makes income smoothing critical. As a single retiree, you often need to use Roth accounts more strategically, be careful with large one-year withdrawals, manage capital gains recognition, and monitor IRMA thresholds more closely. The margin for error is smaller. When you don't have bracket width to absorb income spikes, precision matters a whole heck of a lot more. You also must be more creative in how you take your income. Understanding how things like capital gains taxes versus ordinary income taxes can eat into your portfolio are really important. Say you have $1 million and you need an extra $15,000 of income. If you pull it from an IRA, that $15,000 is closer to $19,000 after you account for taxes, assuming you're in the 22% tax bracket. That is nearly a 2% incremental withdrawal rate on top of what you're already pulling. Compare that to a brokerage account where the taxes are only 15% on the gain, and that same $15,000 withdrawal could look something like this. $10,000 is a return of basis, which you pay no tax on. The other $5,000 is gain, taxed at a 15% rate, which increases your taxes by only $750. So the total withdrawal is closer to 1.5 to 1.6% of your account value. And that $4,000 difference might not sound like much, but sustaining that over a 20 to 30-year retirement could be the difference of not having flexibility later in doing what you want. Then there's survivor risk planning, even when you're single. And I know that sounds counterintuitive, but survivor planning still matters even when you're the only retiree. Why is that? Because there's no one to absorb the financial shocks with you. If you experience a market downturn, a health event, a housing cost increase, or an unexpected expense, you don't have a second income or shared cost structure to buffer it. Married retirees shared fixed costs: housing, utilities, insurance, property taxes. A single retiree, they carry all of those alone. That increases the sustainability pressure of your portfolio. Sequence of returns risk also hits differently. If you're a couple, you can temporarily reduce spending together. There's shared flexibility. A single retiree may have less room to compress expenses. This is why many single retirees benefit from slightly more conservative withdrawal assumptions, not because they lack assets, but because they lack cost sharing. They also tend to need to have more conservative portfolios overall. The last thing you want is a big market correction to wipe away your money. So by being more conservative, you negate that. But you also miss out on the upside of a more aggressive portfolio. This is not always the case, but I do see it happening more often with single clients as opposed to married ones. Then there's the long-term care risk concentration. This is one of the biggest blind spots for single high net worth retirees. Long-term care risk is concentrated risk when you're single. If you're married, one spouse often becomes a caregiver first. That delays or reduces paid care expenses. And as a single retiree, that informal layer, that often doesn't exist. If you need care, it's often fully outsourced, fully paid, and it's fully your responsibility. And with $1 million in assets, you may not qualify for assistance, but you may not be wealthy enough to ignore the risk either. That makes long-term care planning far more central to your retirement design. This doesn't automatically mean buying insurance. It means testing your plan for a 3 to 5 year care event, creating reserve buckets, protecting liquidity, and evaluating hybrid or self-funding strategies. The cost of ignoring this is high because there's no spousal fallback. There's also an emotional side of retiring single. Retirement planning is math, but retirement living is behavioral. Single retirees often face social shifts, housing decisions, relocation trade-offs, and community planning. And those decisions influence spending patterns. For example, downsizing may reduce expenses and free capital, but relocating to be near family may increase housing costs and state taxes. Every decision interacts with income and tax planning. Without a second person weighing decisions, clarity matters even more. Let's go over a practical example now. Consider a 61-year-old single executive with $1.2 million in total assets. $800,000 of those are in traditional retirement accounts, $300,000 is in a taxable account, 2/3 of which is gains, and $100,000 is in Roth. They plan to retire at 63. They would like to spend around $80,000 annually, and their current Social Security benefits at age 63 are $2,000 a month. At full retirement age, those benefits climb to about $2,600 a month, and at age 70, they increase to about $3,300 a month, and assume a real 5% rate of return on all of their investments. A lot of traditional advice would sound a lot like this. Delay Social Security until 70, spend from the taxable account first, and do your best to limit expenses more. With traditional advice, they would run out of money in their taxable account around their mid-60s, paying capital gains on roughly $60,000 of those distributions annually. They would then tap into their IRA and withdraw around $95,000 annually to meet the spending needs. Roughly $15,000 of that a year would go to taxes. And by the time they take Social Security at age 70, they'd have around $500,000 left in their IRA. Social Security would start at that point and offset some of the IRA distribution, but they would still need to pull out roughly $50,000 to meet their spending needs. Taxes would decrease slightly to about $13,000 annually. Then by 75, they'd have roughly $250,000 to $300,000 left in their IRA. Nothing in the taxable, and the Roth would have grown to about $180,000. So the portfolio in this instance was roughly a third of what it started out as. Alternatively, they might want to consider taking Social Security at full retirement age, filling up the 12% bracket first with IRA withdrawals, supplement income with the taxable account, and leave the Roth alone as long as possible. With this new strategy, assuming the same growth rates at age 75, they'd have roughly $400,000 in traditional funds, $100,000 in taxable accounts, and the Roth would be worth the same $180,000. That is still roughly 50% of the starting value, which gives them more flexibility. And that difference is due to income sequencing from Social Security and a lower overall tax burden. This does not even consider the other options to guarantee more income for them, which in this scenario may be prudent. They would want to look at bonds that could provide more stability and a higher dividend payout, or alternatively, an annuity to act as a guaranteed income source for the rest of their life. Neither should be more than the bulk of their portfolio, but a small portion to provide the stability and longevity protection they need could drastically reduce their overall risk. In this example, each scenario started with the same net worth, but had a very different outcome. So why is the $1 to $2 million range a tricky range for singles? Well, if you have $500,000, government benefits may dominate your plan. If you have $20 million, you can often absorb inefficiencies, but in this $1 to $2 million range, you're wealthy enough to have tax complexity, but you're not wealthy enough to ignore optimization. You can't afford sloppy sequencing, you can't ignore bracket compression, and you can't assume markets alone will fix planning gaps. That makes proactive strategy essential. Planning 5 to 10 years before retirement is the most powerful planning window before income becomes fixed. In your late 50s and early 60s, you may have earnings variability, bonus control, deferred compensation decisions, and Roth conversion flexibility. But once RMDs begin and Social Security starts, flexibility shrinks. For single filers, this runway is shorter and more valuable. The bottom line here is if you're single and have $1 million or more and retirement is approaching, your math is different. You don't have a second Social Security check. You don't have bracket layering or cost sharing. You don't have informal caregiving support built in. That doesn't mean retirement is harder. It means precision matters more. Income sustainability, withdrawal sequencing, survivor risk planning, and long-term care concentration all require intentional design. If you want help building a retirement plan tailored specifically for a single high net worth retiree, that's exactly what my team does here at NavWealth Partners. Thank you so much for watching, and as always, make smart money decisions.